You're very kind. Look, those frameworks are fundamental to how I've approached my entire investing life. I don't know if it's exactly a religion for me, but it certainly helps us frame the conversation and the discussions. Look, I think it's fascinating. I sit here today, and I think most of the Mag 7 is down on the year. The core, I think, concern amongst many of them you highlight, which is all this capital they're spending. Amazon, for example, announced $200 billion of capital spending, and the stock went down 10%. I could think of no better company on planet Earth that would be better positioned to think through capital allocation and investing as they build out global infrastructure than Amazon, but the market doesn't like it for now.
Can I rip up the script?
Do it.
Let's go to Whole Foods. We're in section 3 here. You know Amazon better than anybody I know. You were involved in the Whole Foods transaction. How has that thing worked out for Amazon?
I mean, the irony of that question is we live in a world where everyone's debating how they're going to get AI-abled out of the market, okay? This story about Amazon and books and into media was to crush Main Street, to crush the bricks and mortar, right? And here we are, 15 years after that thought, Amazon bought physical stores from Whole Foods. And oh, by the way, today in North America, 20% of all commerce is done online, which is to suggest 80% is still done, in the physical landscape. And it's just a reminder to say, let's be careful about how weak we think the barriers are Charles, to many of the incumbent businesses.
You misunderstood my question. My question is why, when I order from Whole Foods, are they always out of 1% milk?
They are,
the irony around that transaction, if you want to go back and litigate it, is Whole Foods had no technology. It was it hadn't integrated a roll-up strategy into the organic market. Amazon saw that as an opportunity, and it was known as whole paycheck. The minute Amazon bought Whole Foods, no one worried about the price of salmon. Here's the irony. The basket at Whole Foods today is amongst the highest priced baskets in North America. It's still significantly more expensive than a basket at Walmart.
Even if you're an Amazon Prime member, I agree.
Even if you're and so it was brilliant from that perspective as well.
See how he gets going on there?
We really riled him up.
It's good stuff.
I kept out. I didn't mention avocados. Alexis Christoforous with Charles Kantor of Neuberger Berman.
I don't want to make it all about Amazon, but I do want to ask this because I saw it in my own neighborhood. So they invested big in physical stores through Whole Foods. What happened to Amazon Fresh and Amazon Go stores here? Because they're closing them.
Not all of their capital is going to work out. And so, I mean, the definition of convenience has changed a lot. Today, convenience is, can I order my 1% milk from my living room? In the old days, could I get my 1% milk within 5 minutes of my, of my apartment. Look, I think the thing that doesn't get discussed enough, in my opinion, is how remarkable these very large companies are. They have invested enormous amounts of dollars into both R&D and into capital. In 2026, these 7 companies are going to outspend the entire healthcare sector on R&D by 3 times.
That's incredible.
And so that would suggest to you that they're building, lots and lots of optionality into their businesses. And the idea that these businesses are going to win, especially in an environment that is as uncertain as it is today, because they have so much flexibility to invest, to build for the future, and to deliver for customers.
Charles Kantor with us as we have economic data coming out here. Futures deteriorate, negative 48, Dow futures negative 435. The VIX gives some tension, 24 level, out to 25.83, up 1.60 points. Claims is showing the glorified job market, 213,000, pretty much stasis there, as well as the 4-week moving average, where I see the tension less in housing and the data on imports and exports. This is ancient for January, shows all sorts of tariff effect. Charles Kantor on the tariff flow through into revenue and earning dynamics and free cash flow dynamics.
Look, I think many companies absorbed a lot of the tariff themselves and passed on very little to the customer, and I think it speaks to the quality of the management teams and the scale and flexibility of their businesses that they can do that. No doubt, input costs on tariffs are higher than they would, otherwise be. But when you're in a market as competitive as the U.S. market, you don't get the full, flow-through effects. And the same is going to be true on the energy side, which is what the market's kind of maniacally focused on today.
What about upcoming earnings season? Do you think we're going to hear the word tariff in a lot of those earnings calls?
No, I appreciate you bringing up the earnings story because I don't think it gets discussed enough. Earnings, we've just finished the first quarter. That's the only data we have for now. Revenues up 9%, earnings up 14%, 75% of all the companies either beat or maintained. And it was spread mostly in the technology sector, then of course the industrials. This has been a kind of an earnings renaissance over the last 5 years, and it's the strength of those earnings and those cash flows that I think should give investors comfort as we go through the choppiness of war.
At the margin, can you acquire shares in these hyperscaler big tech companies this morning?
Yes, as long as your view is longer than a week, a month, and a quarter. And I think, as you think about the war, for example, I think the war and investing have a lot of similarities. On the short term, life feels very uncomfortable, very uncertain, and unpredictable. And you've seen that today. And over the long term, the best businesses, the best capitalized businesses, the best businesses that can allocate capital, like the strongest armies, will ultimately win out.